Welcome to Stewardology, a podcast where two worlds collide. In this show, financial advisor Tim Russell and Pastor Drew Gysi are joined by me, producer Tyler Rutherford, to explore the intersection of financial stewardship and theology. Their unique perspectives help Christians and churches understand and apply a biblical framework for everyday financial decisions so Christians everywhere can grow in their walk with Christ through biblical stewardship. Before we get started, we just wanted you to know that the topics discussed in this podcast are for general information only and are not intended to provide specific investment advice or recommendations. Investment and investment strategies involve risk, including the potential loss of principal, and past performance is not a guarantee of future results. Securities and advisory services are offered through Genius Wealth Management, member FINRA, and SIPC. Without further ado, here are your hosts, Tim Russell, Drew Gysi, and Tyler Rutherford. Hi, everyone. Welcome to the Stewardology Podcast. I'm Tyler Rutherford, and I'm here with my co-host, Drew Gysi.
Hey, good morning.
And Tim Russell.
Howdy doody.
I'm sure you guys have experienced this. Have you gone to the grocery store recently?
You know what? I was there recently, and sticker shock, I'll say.
It's like you see the prices of the things that you're buying, and it's like, oh my goodness, there's no way I got to spend this much. Eggs are the big thing for me. I eat a lot of eggs. So,
Same here.
But inflation is hitting us hard, right? It's a reality. It's a thing that exists that we have to deal with and move forward with. As stewards of God's provisions, we're not helpless in these situations. Although it might feel like it sometimes, we're not helpless. So today we're unpacking what inflation is, doing a little bit of a refresher there, how it affects us, maybe who wins and who loses in these inflationary environments, and how do we respond biblically in this matter? How do we actually set ourselves and set our families up for success, even though we're dealing with inflation? So let's get into it, Tim. You're the financial planner. Inflation's like your thing, right?
Yeah, well, is it my thing? That's interesting. It certainly has to do with economics and finance. Certainly something as a financial advisor we're trying to plan and prepare for, trying to help people insulate themselves from, because inflation really erodes one's purchasing power. So if we're going to define inflation, what exactly is it? Well, it happens when the cost of goods, the things that you buy in the store, so goods and services, increase, resulting in purchasing power of the dollar decreasing. Okay, in English, what that means is if you make $3,000 a month, but your rent goes up by $200 and the gas bill goes up by $200 and groceries goes up by $200, you're now dealing with less disposable income. The cost of goods increases, reducing the purchasing power of your dollar. Your $3,000 income simply does not go as far as it once did. Now, you can go back to episode 43 in our back catalog and learn more about inflation. I'd encourage you to take a look at that. But really, inflation is a kind of a tax. It's an invisible tax on everyone. And in that way, it's what's called a regressive tax. So in tax language, there are progressive taxes and there are regressive taxes. Progressive taxes are taxes which are graduated, like our tax system. It's 10% for the first $10,000 and 15% after that. And every marginal bracket you go up, your tax rate goes marginally higher. That's a progressive thing. It progresses higher the more you make. However, that's not how inflation works. It is a kind of a tax, and I'm going to explain that in a minute, but it's a regressive tax because it affects those on the lower end of the income scale more profoundly than it does affect those on the higher end of the income scale. Okay, so that's really interesting. How is it a tax? Let me explain. It's a tax because inflation is caused when the government, oftentimes it's the government, there are sometimes some other factors, but usually it's by the government stepping in and trying to manipulate or influence a market or an economy in a given way. One of the most recent ways that we've seen inflation come to bear is through the COVID crisis responses. if you look at something called money supply is simply how many dollars are out there in bank accounts that are liquid and available and able to be used for purchasing goods and services. The money supply during COVID nearly doubled. The amount of dollars in our economy shot up dramatically as the government's way of trying to help buffer our economy from the worst effects of the COVID crisis, the lockdowns, the draconian measures that they put in place to try to protect everyone's life and sanity. It was a terrible idea back then, and now we're reaping the terrible effects of that really awful policy, which is a tax. That instead of just taxing us more to be able to provide more cash to our economy, they just invent more money. Literally, someone in the Fed goes to a terminal and invents new dollars, adds a couple zeros at the end of the Fed's bank account, and they inject that money into our system. They inject it onto the balance sheets of banks. When they do that, they're increasing the money supply. They're increasing the number of dollars chasing the same amount of goods. When the number of dollars increases, but the amount of goods or services do not, what happens is that the cost of those goods and services rises to the level of how much we have for our money supply, how much money is actually available to buy those goods. So it is a form of tax. And this is the thing. The most progressive people on our political spectrum are the ones who want to tax the rich. They want to make the rich pay their fair share, but their policies create the most regressive tax, the one that affects the poor the most. And then their policies, in response to let's help the poor, is to increase taxes and to cause more government spending when we don't have enough tax revenue base to support the taxes we're already, the benefits we're paying. That causes even more inflation. It's a hidden tax. The left is essentially destroying our lower income, poor population through their influence of inflation. So, yeah, you may be able to sense my political leanings here. I am very much opposed to government spending that results in borrowing money or inventing new dollars, which causes inflation.
That's really interesting. So how is this inflation thing measured? And is inflation a good or a bad thing? Because we've talked in the past how the Fed tries to keep inflation at a certain number, right? So can you
2%
talk about
they
that?
say.
Yeah,
2% is what they say.
Well, that number changes from time to time. The Fed sets a goal.
Yeah.
Their goal is 2% or 3% or whatever the right number they feel is. And the way they measure inflation is something called the Consumer Price Index or the Personal Consumption Expenditures Price Index. These are different ways of measuring, are things that we're buying and using, are they getting more expensive or less expensive? So if you go and just Google CPI or Consumer Price Index, you'll find the website from the government, which actually breaks it down, and you can see how much of it comes from this sector of our spending or that sector of our spending. So what happens really is the government's doing a survey, and every month they're going out and they're saying, how much does a carton of milk cost, or a dozen eggs? How about a steak or ground beef? Or what about what does it cost to, get your taxes done?
Gallon of gasoline.
Right. All of those things are rent. Housing is a big part of it. That's actually been recently, that's been the biggest cause of inflation. Sure. Is the increased cost of housing. So that's a major factor. Add all those things up, and then we take that number, compare it to last month's number, and is inflation higher or lower? That's all they're doing. And actually, they don't look at it. They look at it from month to month, but they look at it as a rolling 12 months. They said, based on
year
this
over
month's
year.
Year over year. Based on this month's number, year over year, we're up 4%, we're up 5%, we're up 2%, whatever the number happens to be. Okay? So different measures, Consumer Price Index or the Personal Consumption Expenditures Price Index. That's a mouthful. The PCEPI. Doesn't roll off the tongue like CPI.
Does not.
No.
But Tyler then asks a question, again, coming back to your economics mind, is inflation good or bad? What are your thoughts on that, Tim?
I think on its base level, inflation destroys wealth, potentially, if we're not positioning ourselves well and properly. We don't like deflation. Deflation is bad. Massive inflation is bad. Moderate to low inflation over a long period of time is not necessarily a bad thing. In fact, what it indicates is there's some amount of expansion of goods and services.
But what would be a long period of time in your mind or the government's mind?
So we want stable inflation at a low level for a long period of time, which would be like 10, 20 years. You don't want big spikes and big swings in inflation. We don't want inflation to be 2% this year, 10% next year, -5 the following year, up 7 the next year. Like, there's no way for businesses to predict and to price and to pay employees the appropriate amount of salary. Right? That becomes very difficult for businesses to plan. And the government doesn't like to hear this, perhaps. But our economy runs not because the government gives it permission. Our economy runs because businesses are getting out there and getting it done, providing services and products that people actually want and need. So the more difficult you make businesses to be profitable, businesses to predict the future, businesses to control their expenses, the more chaotic, the less productive our economy is, the lower our gross domestic product becomes, which is the measurement of how productive we are as a nation, which results in the poorer we are as a nation. And when we're all poor, that's equal, but that's not good.
So I was thinking the other day, interest rates over the last couple of years have been higher than what we've seen previously, maybe before COVID.
Yeah.
And so my wife and I carry some student loan debt at a fixed interest rate, and it's lower than what is offered now. And so it got me thinking, are there winners and losers in an inflationary environment? Maybe we can think about, are there groups of people or businesses or what have you that may operate better in an inflationary environment than other people? So who wins and who loses? Let's get started maybe with who wins, because I think that's really what people are interested in.
I mean, the first thing I'm going to say is everyone loses.
Everyone
loses, but there are some things that are less impacted and potentially helped by rising inflation. Okay, borrowers on a fixed income, your example. So if you have a mortgage at 4% and you're making $5,000 a month, in 10 years, you might be making $7,000 a month, but your mortgage is still at 4%. You still have your same monthly payment. As a percentage of your income, your mortgage payment has gone down, not up.
Yeah.
Inflation in this one instance has technically helped. And by inflation, I mean that that you're being compensated more, on your production skill, you're becoming a more skilled and valuable employee, but also because the cost of living increases and there are appropriate adjustments to the cost of living benefit. So yes, fixed interest rate borrowers can be helped over time with inflation. That, by the way, is not me saying go out and borrow money. That's not saying, hey, you should go leverage money now because it'll be cheaper to pay back with inflated dollars. I don't like that. I don't want to bank on or bet on inflation. In fact, I want inflation to be low. All things being equal, you should pay it back with the same value dollars that you are receiving. And that's not me saying that we shouldn't go to a variable interest rate society. I think that's also bad.
Well, you brought up the fixed rate loans, which I think a lot of people in the mortgage industry wind up getting that.
So borrowers at a fixed rate.
They get these fixed rates.
On the flip side,
there's a variable rate.
Absolutely.
And I think that's good to
talk about. And the lenders in that case are the winners.
Yeah.
So if we have a fixed rate borrower, the borrower wins, fixed rate loan. But if we have a variable rate thing, well, obviously the opposite is true. The lender wins because the interest rates may increase with inflation, helping to staunch the impact of inflation on their actual returns. Another example for winners might be asset owners. So you own your home. Your home goes up in value. You're essentially benefiting from inflation in a sense because that value increases. Obviously, your home price is not simply going to be impacted by inflation. There are many other impacts that are going to come into play, like supply and demand, the value of your home, what your neighbor's doing with the 15 cars in the front yard. Like all of those things are going to affect
location.
Yeah, all those things are going to impact pricing. But all other things being equal, inflation will help improve asset prices. So that also applies to equities. You own stocks, bonds, mutual funds. Those things are, I should rephrase it. I said equities and then I used the word bond. Bonds don't apply. Bonds are a different category. Stocks, mutual funds, ETFs that are equity-based, stock-based could also see improvement because if we've got companies that are increasing their costs, that increases their revenue, and therefore, theoretically, that should also help with their profits. Businesses are better able to deal with inflation because they pass those costs on to the consumers, hence inflation. And then another example would be commodities, where we all know about the price of eggs these days. It's a commodity, right? It's something that we consume. Gasoline is a commodity. Oil, corn, coffee. Here you go. Coffee's my commodity.
We will do the coffee thing. Here we Tyler. What?
Okay.
Tyler,
No coffee today.
Tyler,
No coffee.
he'll be snoozing a little later on in this.
So these are commodities, and those prices generally increase during inflationary environments. Not universally, but generally. Okay, some other things. We talked about owning stocks and the benefits of owning stocks. Well, that also is true for people who just own a business. If you own a business, inflation can be good for your business, potentially, if it's modest inflation. Hyperinflation, inflation shocks are always going to be bad for business. But when you have some moderate inflation, it can be helpful because businesses have the ability to pass cost increases on to consumers. Workers in high demand sectors. If your job is one that cannot be done without you there, you have the ability to charge whatever wage your job can supply. Now, it has to be true, and we're going to talk about this in subsequent podcast episodes. You can never pay someone more than their labor generates. So if your work generates $100 an hour, your boss is never going to pay you $150 an hour. There's no way for that to happen. But if you're a high demand, high skilled, high valued employee that's generating $200 an hour, yeah, they can pay you $100 an hour, $150 an hour. It all depends on how much value you're generating.
So real quick, just on that, you're talking about high demand jobs. Off the top of your head, what would you label in today, 2025? What would be some of those high value jobs that you're thinking of?
Trades, perhaps?
So you're right. So if you look at something that cannot be replaced by artificial intelligence, AI is not going to fix your toilet.
Yeah. Good.
Right? They're not going to run the wire in your home. So yeah, welding can't be done by artificial intelligence, generally speaking. So yeah, there are certainly skilled jobs in the trades that are examples of that, but there are other high value jobs that are, like always going to be in demand. Doctors, for example, surgeons are going to be in demand. We look at people in professions that are aging out, tax preparation. Yeah. We're finding that there are fewer and fewer tax preparers because they're retiring, because the industry is just becoming nuts. Well, the people who remain are able to charge more because there are fewer people doing the job.
That's interesting you bring that up, because in our seminars, I talk to a lot of people and they come up to me. They're like, I just don't want to pay this big fee to get my taxes done. And Tim, I think you answered the question why it's costing so much to get tax preparation done today, because of what you said. They're aging out and there's not a new group coming in. So that becomes a high demand piece. So if you want to make some money and only work a handful of months a year, that may be your ticket.
Yeah. So the last item we have on the list of potential winners is one that I really dislike. And I think that there's a moral hazard even by mentioning this, but I feel like we must. Governments with high debt could potentially benefit by inflating their currency and paying back old debt with lower cost currency with higher currency, right? So how does all that work? That kind of sounds confusing. If you have money supply at, let's just say, a unit of 50, and all of a sudden you've increased your money supply to 100, well, if you're paying a debt payment, and let's just say that debt payment is 10, and now you don't have 50, you have 100, you can now pay it back with that 100, not with the 50. You've inflated your currency. You've devalued your currency so much that it's a lot easier to pay it back. That is a moral hazard. That is why I absolutely hate the fact that the American government is not living conservatively. They're not using good financial principles, sound money principles. We are borrowing money, hundreds of billions of dollars a year, in order, actually, I think it's like to the tune of $1 trillion a year. We think we make $2 trillion, we spend $3 trillion. We have to borrow $1 trillion, if my memory's correct. It's insane. Why are we doing this? That's causing us to borrow more money, causing more inflation, and with those inflated dollars, we pay back that debt.
And that's that regressive tax on the poor.
Yeah.
Exactly. Yeah. Thank you. It is a regressive tax. So yes, we're paying for it with taxes, but not a formal tax. It's a hidden tax, and it's an invisible tax that is the most destructive on people on the lower end of the income scale.
That's wild. My blood pressure's a little high now.
Yeah, I'm not feeling good about this. So we just talked about all the winners. Who are the losers?
Well, you don't feel good about the winners list. Man, we're going to feel bad about the losers list.
Should we just close out right now?
Just end the episode.
We're ending the episode. Just Google the rest.
Okay, who are the losers? Savers.
Oh, man, come on.
Okay, pause, because I've got good news with this as well.
Okay, please.
Savers are potentially losers because they lose purchasing power. If you have money invested in the bank and your bank account's paying you 2%, but inflation's 4 or 5, you're losing 2 or 3% every single year. Not in terms of actual value, but in terms of purchasing power. Yeah. The purchasing power of the money in the bank at 2% is losing essentially 2 to 3% in my illustration if you have 4 to 5% inflation.
We like to say it in the seminar, you're losing money safely.
Yes, that's exactly right. You lose money safely, as opposed to putting it in the market where you could potentially lose money with a little higher degree of emotional impact. You feel that a little differently.
Sure.
Okay, so savers. However, the good news on savers is people absolutely need to have cash. You should not be investing all of your cash into the market or into some other form because you need to be able to avoid borrowing. You need to avoid future debt. So cash is one of the ways to do that. So yes, I am happy to lose a little bit of money with my money sitting at 2% in the bank. I'm happy to lose a little purchasing power if it means I have more confidence that I can handle the unexpected debt.
Tim, that's a great point to really camp on for a moment because a lot of people just get that fear of I'm losing a couple percent. But in the end, it's actually going to be a major benefit for them.
Oh, yes.
So I think that's important for people to grab a hold of that truth.
And I noticed during COVID, let's say pre-COVID, you had your money in a savings account paying you 0.01% interest. Right now, like I think my high yield savings account's like 3.6.
That's what they're getting now, 3.6.
Now, you're not outpacing inflation, but you're certainly getting a little bit more in that account compared to previous years.
Absolutely. Yeah. Okay, so losers. We've got savers can possibly lose through purchasing power. Low risk savers, that's people who use CDs or bonds. These are another cash-oriented form of investing money that doesn't really benefit from inflation. Again, what's happening with a bond? You are lending money to a company and they are promising to pay you back at a certain interest rate. Your upside is that interest rate.
And it's locked most of the time, right?
That's correct. It's not a variable rate. So your upside is if they pay back the loan, they pay back that bond, they give you that interest rate back, you just get the modest amount of interest income. That's it. So yes, the same story with the savers. There's a potential loss in purchasing power. Another example of loser would be a borrower with an adjustable rate mortgage, a variable interest rate loan. So this could be mortgages that are ARMs, adjustable rate mortgages, credit card borrowers, or other variable rate forms of debt. So any revolving debt, home equity lines of credit, for example, could be harmed because when there's inflation, generally interest rates go up. And when interest rate goes up, that means the amount of your monthly payment is going to increase. The minimum payment will increase because your interest rate has adjusted.
That's a scary thought. Like your mortgage going up, a couple $100 just because inflation's going up.
Well, yeah, and it can be even worse if you not only have an ARM, but have a ballooning ARM.
Yeah.
So if you have an interest-only variable rate loan with a 5-year balloon, you have the opportunity for 5 years to pay only interest, just that small variable rate interest. And that's not a big deal. But in 5 years, it balloons to a potentially massive payment to pay back that principal. So, yeah, it could be even worse.
And if you don't prepare for that day.
Oh, yeah. Yeah, so many times lenders simply think that they can refinance their loan in 5 years. But their entire economic reality could have changed. They could have gotten sick, lost a job. They're like a major employer in their town has left, so the home values have decreased. Any number of things could happen that would potentially impact the ability for someone to get out from that ballooning loan payment.
Wow.
Real quick on that, the variable rate balloon, is there value for the common homeowner type person to go into something like that?
Almost never. Almost
that's
never.
what I thought the answer was, but I needed to hear it from you.
Yeah. The only example for someone who could theoretically benefit, and remember, with a benefit here, there's always a risk involved.
Yes.
And anytime you borrow money at a interest only with a balloon payment, you're increasing your risk spectrum by many-fold. The person that potentially could benefit is if you know that you're moving in a year.
Okay.
So there's no option to not sell your home, and you have enough equity in your home that you can borrow the money, pay back only interest, and then allow the rest of the loan to be paid off when we go to closing, and the new buyer essentially pays off your mortgage.
And that's not a normal aspect of society today.
No, it's not something that we would typically recommend.
Yeah. Good.
All right.
What else?
So we talked about fixed rate borrowers being benefited from inflation. Fixed rate lenders are hurt when there is inflation. Again, same story. You're getting paid back with inflated dollars. So the amount of purchasing power of the dollar coming back to the lender is not as much as the purchasing power of the dollar is lent out. See how that's different.
Yeah.
We have other examples, people on fixed incomes or retirees.
Yeah.
If your Social Security or pension income, it has no ability to adjust for inflation. And I know there is an adjustment for Social Security, but oftentimes Medicare takes it all. Thank you very much. There's your inflation adjustment. You can now pay a little bit more for Medicare. Those individuals are disproportionately impacted by inflation because the purchasing power of their income is reduced, but their income does not increase.
And that's another reason why we've talked about this in previous episodes. A person should not solely expect that Social Security is their sole means of retirement.
Yes.
Because it's going to continue to go down and down and down because
Yes.
they're going to increase it a little bit, but it's going to be pulled out for the healthcare pieces, which will always increase. So that's the challenge. So please make sure you have something outside of your Social Security income in those latter years.
Yeah. All right. So there are a couple additional losers. So low wage, low skilled workers and the unemployed. These individuals are always going to be impacted because, again, they're not able to generate more income to compensate for the rate of increase for inflation. Maybe three more here to address. An interesting one is renters. Renters lose in an inflationary environment. Let me give you an example. I've got a friend of mine who has been renting for a long period of time. He's had a lot of a complicated medical history and work history that have prevented him from really growing in his career and doing well. He's now at a place where he and his wife are starting to make some decent money. They've gotten a good amount of professional accomplishments, but now they're later in their career, but they've been renting their entire lives, and the rent keeps on going up.
Wow.
So for them, they're getting into a fixed 30-year mortgage. They're buying a house for the very purpose of being able to insulate them from rising rents in retirement.
Yeah.
They at least know they have a mortgage payment with a fixed rate that they can currently maintain, and Lord willing, they'll be able to continue to work for a number of years and be able to make sure they can maintain their standard of living. But at the same level, they know if something medically happens and they have to, they can't afford the house, they could always sell and trust that the value of the home has increased as we talked about the winners being the real asset owners. That goes up in value. That's going to help them figure out what to do with the money and where to go.
Yeah, when I rented for 3 years, and in that 3-year span, my rent increased by 35%.
Seriously, in 3 years.
3 years, 35% increase. So, even if you own a home, even if property taxes are going up, they're not going up 35%, right? So, yeah, being in a situation where you're renting, you're definitely at risk for inflation, and being able to own a real asset like a home shields you from that a little bit more.
And it wasn't just the cost of rent going up. You had the utility costs and everything.
Too,
yeah.
And you still had to deal with the price of eggs going up.
Yeah, and those darn eggs, yeah.
Just have chickens run around the apartment.
That's right.
So another example of someone who loses would be a consumer of essential goods, those raw eggs. Those commodity prices go up, your cost of raw goods will increase. And then finally, businesses that are in a low margin industries. They don't have purchasing price power. They don't have the pricing power to adjust their prices effectively. If they adjust their prices, their competitors won't, and they'll lose their ability to stay in business.
What's an example or two of that?
Well, grocery stores are one example.
That's a good one.
Because they are a notoriously low margin business. However, because inflation affects all grocery stores equally, or generally speaking equally, it will cause them to raise prices. All of them will. The difference is that bigger companies who have more purchasing power or able to get bigger volume discounts will be able to absorb those cost increases better than smaller mom and pop grocery stores. That's why you see most small mom and pop grocery stores going out of business. Yeah. That's why even small chains are being gobbled up by bigger chains. Only the big can survive in these kind of environments. They don't have the ability to adjust their prices to compensate for what Walmart can do in their grocery department. They are now the biggest grocery store in the world.
For 40 years, my wife and I have been going to the Jersey Shore, into the Brigantine, New Jersey area. And back 40 years ago when we were down there was 2 mom and pop grocery stores that half the size of a house, a quarter the size of a house. And we used to go there, get the stuff that we need, and it was pretty good. They're gone.
Yeah.
You got one grocery store, one big name box, brand name store, but the small mom and pop stores are gone.
So inflation, from our conversation today and previous conversations, it's pretty much out of our control. There's nothing that you and I can do to really control inflation, but there are certainly some things you can do to prepare yourself and maybe shield yourself from some of those negative effects of inflation. And so what is the first thing that we can do to shield ourselves from that a little bit?
Increase your skills. Become highly valuable and highly skilled in your job. That is probably the most important way to insulate yourself from inflation. Be so good they can't ignore you. Be so valuable they can't afford to lose you. So that means get the education that you need, get trainings and certificates that you need, really invest in reading books, taking classes, listening to podcasts, like the Stewardology Podcast.
Ooh, what a good one to listen to about some economics and stuff.
Yeah, I like to I like to share the quote that was really impactful to me. In 2 years, you will be the same person you are today, except for the books that you read and the people that you meet. This is not original to me. I forget exactly who said it, but this is something that I really do believe to be true. If you're not reading and growing and investing in new relationships, you're not going to be changing at a level to keep you relevant in the marketplace of ideas.
Proverbs 22:29, I was looking at some different passages of scripture, and that ties in so well with what you just talked about, increasing your skills. It says, "Do you see someone skilled in their work? They will serve before kings. They will not serve before officials of low rank."
Yeah.
If you're skilled in something, that's going to move you forward. So what you just said, Tim, is right out of what the Word of God is speaking about, and that's what we ought to do. Let's consider taking those 2 years, learning, growing, doing better with who you are and what you're passionate about, and then God can use you in greater ways.
Yeah. So God honors diligence.
Yeah.
Like sharpening your skills ensures you're valuable even in an inflationary economy. Okay, here's the problem. Not everyone has the ability to increase their skills and their abilities. Maybe they're retired or disabled, or there are other factors going on. Another piece of advice, another step that can help is simply by building margin in your life, in your budget. We need to live at a level of consumption that is lower than our income. If you make $5, but you spend $4 or $4,500, your level of consumption is lower than your income. That difference is called margin. That means you can absorb some costs of living increases. You have places where you can adjust and change to make sure that you can meet your ends meet.
There's some ways that you can, make that margin happen. You can refine your budget, find those unneeded expenses, get rid of them, create a little bit more margin. You can pay off some debt and free up more of your income to be able to absorb some of that inflation. And obviously, I think one thing that we all need to do is make sure that we have an emergency fund. To be able to grow that emergency fund is important so that we don't go into debt when hard times arise. And nothing's worse than going into debt during a time of inflation where the interest rates are higher, right? We don't want to do that.
Yeah.
So pay off your debt, grow your emergency fund, create that margin that allows you to insulate yourself from that a little bit better.
A little bit better. That's right. And one other maybe note to go along with that is to recognize that we build our margin by being disciplined with our spending. We have to be disciplined with our spending. Remember Parkinson's law. Parkinson's law says that it's applied to a lot of different ways, but in the spending area, spending expands to the amount provided to it. In other words, in English, what that means is if I make $5,000, but I'm giving 10 away to church, and I'm taking 10 and I'm putting it in savings, I have 80 left to live. You'll find a way on living on 80. You will. You absolutely will. So create artificial constraints to make you live within your means. It takes a little bit of work and effort, but if you don't force yourself to live on less, then you won't have the margin to survive an inflationary environment without destroying you financially by increasing your debt, decreasing your reserves, and increasing your stress.
And Hebrews 13:5 talks about being content with what you have. It's not what you want, it's what you currently have. There's that element of contentment saying, I'm okay with what I have. Yes, the neighbors are getting new cars and they're getting pools in their backyard. You know what? My 12-year-old Chevy is working really good. Guess what? Yeah, I may need to put new tires on the thing, but guess what? I'm going to be rolling down the road again. So be content with what you have and don't always have to look for the new, the best, and the shiny.
So we got number 1, increase your skills. Number 2, build margin. What's our third step?
So our list here says own assets that grow in value, like stocks and real estate. I'd like to modify it from own to invest in. Because I think it can sound nice to say, well, simply own more assets. Well, how do I own these assets? Well, you have to invest in them. So start with putting money aside into a fund so that you can buy a home, piece of real estate. That is a good investment. So cash in the short term, so you can invest in real estate in the long term. You can also do that through investing in Roth IRAs and 401ks and other investment-oriented accounts. Retirement accounts is a good example of that. So own assets that tend to grow in value. Look at the list of assets or things that do well in an inflationary environment and invest in those things. Invest in businesses, invest in stocks, invest in mutual funds that have the opportunity of growing in an inflationary environment.
So what's the fourth step?
Start a business. Look, I am a huge fan of businesses. Yeah. And frankly, if you want to alleviate poverty, if you want to improve the economy of the United States, go out and start a business. Go out and serve people, provide products and services that make people's lives better. You become more successful when you're helping more people succeed, when you're solving problems that people are facing. So start a business. Yes, it's scary and it's expensive, and businesses fail. There's failure in business. It's absolutely a thing. But if God has gifted you with an idea or with the resources or with the ability to go out and do something gutsy and risky, something that is just really impactful, that is a good thing. You employ people. You are providing for your family. You are injecting income into an economy through meeting other people's needs. That is capitalism at its best. That's not some kind of evil form of capitalism. In fact, eat the rich means that we'll all have nothing left to eat. So we really need to have people to invest in businesses, because that is one of the best ways of managing inflation. By the way, you'll employ people, which you'll help them to manage and deal with inflation. Think about my company itself. 20 years ago, I think we had 4 people here. 4 people.
Is that what it was? 4 people?
Yes. We had a client services person, the advisor, maybe 2 other advisors.
Wow.
Not many. Maybe it was 25 years, but there's very few people here.
Wow.
Today, we have 17 people on staff.
Full-time,
17 people. What that means is that we have grown in terms of not only the revenue that we as an organization generate, but also the support that we're providing to our team members who are helping bless our clients and make their lives better. Because we employ people, we're making more of an impact in our economy, our local economy, because we're employing people. We're giving them jobs that have living wages that allow them to go and take care of the things that they need to take care of. That is a significant improvement over where we were 20, 25 years ago. So yeah, stuff to think about. Businesses are an important part of helping to deal with inflation.
Yeah, and if you have a business that is actually meeting the needs of people, and you make it really hard for that community to live without your business, what are you doing? You're shielding yourself from the effects of inflation, right? Because you're creating more ways to keep yourself in business, to keep making money, to keep making revenue, and so business owners definitely I think they stand a better chance at surviving inflation than, we talked about earlier, low skilled, unemployed, low wage workers.
Absolutely.
Yeah. Well, as we wrap up today's episode of the Stewardology Podcast, let's remember inflation, it may crown some winners and some losers, although I think we can make the case that most of us lose in the case of inflation.
Yeah.
But as stewards of God's resources, we don't have to bow to inflation. We don't have to bow the knee to inflation. By increasing our skill sets, increasing our financial margin, by paying off debt, maybe starting a business, investing wisely, we can navigate inflation with confidence, right? Not because we know we can solve all of the problems, but because we believe and we know the God who watches over us and who provides all that we need. Scriptures like Proverbs 21:5 and Colossians 3:23 remind us that diligent planning and heartfelt work for God's glory are our real foundation. So what is your next step? Pick one. Pick one. Refine your budget. Maybe read a book to grow your skill sets. Explore what options there are to invest for you. Take it all to the Lord in prayer. Maybe it's something as radical as starting your own business. Maybe that's an option. But trust that God, the one who owns the earth and everything in it, will guide you in this journey. And because of that, we don't have to fear inflation.
Until next time, take care, God bless, and remember, inflation is a hidden tax. Save and invest to insulate yourself from that tax.
Thanks for joining us on the Stewardology Podcast, where financial stewardship and theology meet. We'd like to help you take your next steps in biblical financial stewardship. Subscribe in your podcast provider to get the newest episode delivered to you every week. Leave a 5-star rating and review to help new listeners find the show. Take advantage of your free personal stewardship review at stewardologypodcast.com/review. Be sure to follow us on social media and visit our website at stewardologypodcast.com for tons of free resources and hundreds of free episodes. You can also leave episode ideas at stewardologypodcast.com/idea. Remember, Psalm 20, verse 7, some trust in chariots and some trust in horses, but we trust in the name of the Lord our God. See you next week.